Kia ora, I'm Mary Jo, Kiwibank economist. At the April Monetary Policy Review, the Reserve Bank kept current policy settings unchanged. The official cash rate remains at 0.25%, the large-scale asset purchase program is still capped at 100 billion, and the funding for lending program is still operational. But these tools were never in play. In fact, the April review is really just a stepping stone to the more important May statement, which is when we'll get a new set of forecasts. Now, the New Zealand economy is going through a bit of volatility right now. Since the February statement, the stream of local economic data has started to soften. The momentum in household spending has started to come off, and the critical tourism and education sectors are still largely on standby because of the border restrictions. Also adding to the downside risks are the recent changes to housing tax policy. But looking through all this, the New Zealand economy is ultimately on a recovery path, and it's helped by the upcoming travel bubble with Australia, as well as a vastly improved global growth outlook. So we're doing relatively better than our peers. But in saying that, the Reserve Bank is still far from achieving both its employment and inflation targets. There's still a lot of slack in the labour market, and core inflation remains subdued, even though we might see headline inflation overshoot its 2% target in the near term. So there are a lot of moving parts to consider. And the Reserve Bank has time on its hands to watch how the data unfolds and mull over the recent developments. Now, one thing we were looking out for during the April review was whether the Reserve Bank would extend its forward guidance. When the official cash rate was cut last year, the Reserve Bank said it would keep it at 0.25% for the next 12 months. But that 12-month period ended last March. Now, while the Reserve Bank didn't provide a new time frame, they did reiterate that it still would take considerable time until full employment is achieved, and they're confident that inflation is sustainably back at target. So monetary policy will have to remain accommodative until then. And we agree. We don't think there's a need to cut the cash rate, and it's certainly far too early to consider hiking rates. Markets have priced in a hike by around November next year, and that sounds about right given the risks. That's it for this weekly wrap. I'll talk to you in the next one.